Hi everybody. Today I'm doing a very interesting video where I will be combining elements of IFRS 16 leases and IFRS 9 financial instruments. Now this video is in response to a viewer's query. Thanks Vinay for posing such an interesting question to me. The question that he asked is how do we account for a lease liability that is paid off by using convertible instruments? So I read through all the relevant topics under IFRS 9. I went through all my books, but I could not find a similar example. So what I'll be doing today is giving you my take on how this scenario is to be accounted for using the rules under IFRS 9. To understand the steps that I am taking while solving the problem, you need to be familiar with how to record a lease under IFRS 16. I have done videos on this. I am giving the links to these videos here. Please go through them if you do not know how to account for a lease. You also need to be familiar with the relevant topics under IFRS 9. I have not done videos on this. So what I will be doing is in this video, I will quickly go through these concepts under IFRS 9, and in my next video, I will actually solve the problem. Please note that when I refer to IFRS 16 and IFRS 9, I also mean IND AS 116 and IND AS 109. Okay, let us start. So the first concept is, what is a financial liability? Now IFRS 109 has given a very elaborate list of what a financial liability includes, but we will be only focusing on those items that are relevant for this video. So financial liability is a contractual obligation to, the first one is very intuitive. It is a contractual obligation to deliver cash or financial asset to another entity. Now the second one is the one that is more relevant for our video today, and that is a contractual obligation to exchange a financial asset or financial liability with another entity under potentially unfavorable circumstances to the entity that is recording the financial liability. Some examples are term loans, debentures, bonds, etc. The next question naturally is lease liability a financial liability? Now, conceptually, yes, because a lease liability is an obligation to deliver cash to the lessor. But IFRS 9 has clearly excluded a lease liability from its scope. So why are we even linking up these two standards? Because there is an exception. And that exception is that those provisions of IFRS 9 that relate to derecognition of a liability do apply to a lease liability. And if you see this particular scenario, it does include derecognition of a lease liability and recognition of a new liability in its place. Before getting into derecognition of a financial liability, let us look at how a financial liability is to be recognized. So at initial recognition, the financial liability is to be recognized at its fair value less transaction costs. But in the subsequent years, the financial liability can either be measured at amortized cost using the effective interest rate or fair value. Now, for the purpose of this video, we focus only on the amortized cost method. Next concept that we need to look at is, what is a compound financial liability? As the name suggests, it is a financial liability that contains features of both debt as well as equity. Now, how do we record a compound financial liability in the books of accounts? Well, at initial recognition, we need to split the carrying amount of the financial liability into debt and equity. Subsequent measurement, the equity part remains unchanged, at least till the date of conversion. On the date of conversion, what can happen is that it still stays within equity, the amount, but it may transfer between the line items under equity. But the debt part, that will be recorded just like any other financial liability, either at amortized cost or the fair value. Now we come to the concept of derecognizing a financial liability. Now, when can a financial liability be derecognized? It can be derecognized when the obligation to pay off that liability is either discharged, cancelled, or it expires. Now, how can this obligation be discharged? It can be discharged by either paying cash or giving a financial asset to the other entity, by exchanging the existing liability with another financial liability, or by paying for the financial liability using one's own equity. Now, for the purpose of this video, we know that the question is, how do we account for a lease liability that is getting discharged by an issue of a convertible debt instrument? Therefore, we are focusing on exchange of an existing liability using another financial liability. While giving a new debt instrument in place of an existing liability, the IFRS requires us to assess whether this existing financial liability needs to be derecognized or should it be merely modified. Now, to make this assessment, we need to see whether the terms of the new debt are substantially different from the terms of the existing debt. How do we assess whether the terms are substantially different? The standard is very clear. There are two types of assessments that we need to do. The first one is the quantitative assessment. Now, under quantitative assessment, we need to calculate the net present value of the new debt by using the effective rate of return, or the IRR. Then we subtract this from the original debt's net present value. But at that time, we only take the remaining cash flows. Now, the difference that we get should be greater than or equal to 10%. Only then will we say that the terms are substantially different from a quantitative point of view. Now, if this criterion is met, then what we need to do is derecognize the existing liability and recognize the new liability. The difference between the values of the existing liability and the new liability will be taken to the profit and loss account. Now, what happens if the quantitative assessment is not passed? That means the difference between the new debt and the existing debt is less than 10%. Then what we need to do is a qualitative assessment. Now, the changes in terms relating to interest rate, the annual payment amount, payment schedule, the maturity term, all of this gets covered under the quantitative assessment. So, under qualitative assessment, we look at the inherent nature of the debt. For example, does it include an option to convert to equity shares? Does it require more collateral security? Those kind of things. If qualitatively the new debt is very different from the existing debt, then also we will derecognize the existing liability and recognize the new debt. Now, let us say it fails both the quantitative assessment and the qualitative assessment. Then we do not need to derecognize the existing liability. What we need to do is modify the amortized cost to include all the minor changes in the terms. Okay, so we have covered all the relevant topics that you need to know. Armed with all this understanding, let us go and try and solve the question. The steps that I will be taking to solve this question in my next video are: first, I will recognize the lease liability. Then I will do a quantitative assessment as well as a qualitative assessment to see if the new debt is substantially different from the existing liability. The third, as we know that the new debt is a convertible instrument, so I will split that convertible instrument into debt and equity. Once the initial recognition of the new debt is done, then I will measure the new debt at amortized cost using the effective rate of return. And finally, on the date of conversion or the date of redemption, I will pass the entries to redeem the financial liability. So these are the steps that I will be following to account for this scenario, but I will be doing that in my next video. Thank you everybody for watching this video, and thanks Vinay for posing such an interesting question. If any of you have questions that you would like me to solve, please feel free to put them in the comments and I will take them up. Please do watch my next video where I will be actually solving this problem. And as always, I welcome all your comments, suggestions for improvements and queries on whatever was discussed today. I hope you found this video very interesting. Thank you very much. See you in my next video.